So let's look at these balances, the actual data here, at least from a couple of years ago. This is partly outdated, but you can see the relationship here. So this red line is the current account deficit, and you can see that the financial account, so it used to be called a capital account, it's now called a financial account. So you might see this on some older exams where they call it the capital account. I'm not sure why they discontinued this series. I couldn't find the updated one on the FRED website. This is Federal Reserve Economic Data. It's a good data source, but I couldn't find the proper financial account data for this. But you can see, that it has to be a mirror image of what's going on here, aside from any statistical issues that they might have. But this should match up exactly with what's going on in the current account because we're just looking at those money flows. So if money is flowing towards Germany in that example, well, that money is going to go somewhere. Germans want to earn a return on that money. They're going to be buying some kind of asset, and that's showing up here in this financial account. And so it should be a mirror image of that. So just to make sure we have the complete definition here, the current account, like I said, mainly we're going to be thinking about the trade balance in terms of the current account. But it also includes some other income sources. So investment income, so let's say some foreigner owns a U.S. asset and is earning some income on it. So let's say interest on a bond or something like that. That income payment, that money flow is also part of the current account, and then other types of transfer payments. So people sending money to their family in a different country, something like that. Any kind of transfer of money from one country to the other is also included in here. Generally, trade balance is going to be the major factor, and that's usually what we're going to be talking about when we're talking about the current account. So like we said, the flip side of that is the financial account. So the assets themselves, the purchase of the bond itself, is that transfer of that asset is part of the financial account, whereas the income payment, the money flowing from the income, is going to be part of the current account. The asset itself is financial account. And like I said, it also includes direct investment, so direct purchase of a factory or building a factory or something like that is also included in here. So assets, just think assets versus mainly trade balance, but other income over here in the current account. Here's another way of looking at it. So here we have Japan as our example, and Japan's a relatively high savings country, just like in our example, Germany is running a surplus with the US. Japan in this example, this is some old data probably, but Japan is running a surplus, a trade surplus with the US running a trade deficit. And so you can see now, like I said, you can think of that whole relationship just in terms of savings and investment. And the flip side of that is really the trade balance or the current account balance. So you can see, you can kind of think of the whole relationship being driven by savings investment behavior rather than trade behavior. So it could be that once, let me go back to my earlier slide here. Once you could think of it as Germany wants to invest in the US, and therefore the flip side of that is going to be the trade part of that. So money flowing back to Germany. So going back to this slide. So Japan, high savings country. So here's their savings, private savings, this whole thing over here, and relative to their investments, they have a certain level of investment. So in other words, they have some savings to export to other countries. Whereas US is the flip side of that. So they have a certain level of investment, and so that means, and if their private savings is actually this area here, well, that's not enough to finance investments, so they need to be getting this capital inflow. Here we're talking about financial capital inflow, which is just that financial account balance. So need a capital inflow in order to finance that investment. And notice here we can split it up into private savings and public savings. So here we have U.S. government budget deficits. In other words, they are borrowing in order to finance spending. Well, someone's got to finance that government borrowing. So someone's got to buy up those bonds. So part of the private savings here is going up to buy up those, think of it as going to buy up those government bonds. And then what's left over is available to finance investment. So after buying up those bonds, if you imagine that it's all bought up domestically, which it doesn't have to be, but now this part is left over to finance investment, well, we need some capital inflow if we're going to be financing this level of investment. So that's where, if we assume that we're just have a relationship with Japan here. Obviously, there's lots of countries and a big web of transactions going on here. But so we need that capital inflow. So we need a financial account surplus, which means we're running a current account deficit. Japan is just the flip side of that. So they have a bunch of savings, and they don't need it all to finance this level of investment, so they're going to export it essentially. So this capital outflow, let's buy some U.S. assets. Let's finance this U.S. investment in exchange for some return on those assets. And the Japanese government is also running a budget deficit, so part of those savings is just going up to buy up those Japanese government bonds, and then whatever's left over is available to go finance foreign investment. So capital outflow from Japan, financial account deficit from their perspective, sending that capital over here, financial account surplus, and the flip side of that, current account deficit for the US, current account surplus for Japan. So you can kind of see how these relationships need to work. Like I said, you could think of it as the whole thing being driven by savings investment relationships, and then the trade side being the flip side of that. Or you could think of it as starting from the trade side, and then that sort of forces, what's going on here with the investment savings relationship.